Ladies and gentlemen, the Vice President and myself are very pleased to welcome you to our press conference. We will now report on the outcome of today's meeting of the Governing Council, which was also attended by the Commission Executive Vice President, Mr. Valdis Dombrovskis. While the rebound of economic activity in the third quarter was stronger than expected, and the prospects for the rollout of vaccines are encouraging, the pandemic continues to pose serious risks to public health and to the euro area and global economies. The resurgence in COVID-19 cases and the associated containment measures are significantly restricting euro area economic activity, which is expected to have contracted in the fourth quarter of 2020. While activity in the manufacturing sector continues to hold up well, services activity is being severely curbed by the increase in infection rates and the new restrictions on social interaction and mobility. Inflation remains very low in the context of weak demand and significant slack in labor and product markets. Overall, the incoming data and our staff projections suggest a more pronounced near-term impact of the pandemic on the economy and a more protracted weakness in inflation than previously envisaged. In view of the economic fallout from the resurgence of the pandemic, today the Governing Council recalibrated its monetary policy instruments as follows. First, the Governing Council decided to keep the key ECB interest rates unchanged. We expect them to remain at their present or lower levels until we have seen the inflation outlook robustly converge to a level sufficiently close to but below 2% within our projection horizon, and such convergence has been consistently reflected in underlying inflation dynamic. Second, we decided to increase the envelope of the Pandemic Emergency Purchase Programme, PEP, by 500 billion euros, bringing it to a total of 1,850 billion euros. We also extended the horizon for net purchases under the PEP to at least the end of March 2022. In any case, we will conduct net purchases until the Governing Council judges that the coronavirus crisis phase is over. We will conduct our purchases under the PEP to preserve favorable financing conditions over this extended period. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with countering the downward impact of the pandemic on the projected path of inflation. In addition, the flexibility of purchases over time, across asset classes and among jurisdictions will continue to support the smooth transmission of monetary policy. If favorable financing conditions can be maintained with asset purchase flows that do not exhaust the envelope over the net purchase horizon of the PEP, the envelope need not be used in full. Equally, the envelope can be recalibrated if required to maintain favorable financing conditions to help counter the negative pandemic shock to the path of inflation. The extension of our PEP purchases over a longer horizon reflects the prolonged fallout from the pandemic for the economy and inflation. It allows for a continuous market presence and more durable support from our monetary stimulus. Preserving favorable financing conditions over the pandemic period will help to reduce uncertainty and bolster confidence, thereby encouraging consumer spending and business investment, and ultimately underpinning the economic recovery and helping to offset the downward impact of the pandemic on the projected path of inflation. We also decided to extend the reinvestment of principal payments from maturing securities purchased under the PEP until at least the end of 2023. In any case, the future roll-off of the PEP portfolio will be managed to avoid interference with the appropriate monetary policy stance. Third, the Governing Council decided to further recalibrate the conditions of the third series of targeted longer-term refinancing operations, TLTRO III. Specifically, we decided to extend the period over which considerably more favorable terms will apply by 12 months until June 2022. We will also conduct 3 additional operations between June and December 2021. Moreover, we decided to raise the total amount that counterparties will be entitled to borrow in TLTRO III operations from 50% to 55% of their stock of eligible loans. In order to provide an incentive for banks to sustain the current level of bank lending, the recalibrated TLTRO III borrowing conditions will be made available only to banks that achieve a new lending performance target. The extension of the pandemic-related low interest rate period under TLTRO III, the addition of more operations, and the increase in the amount that can potentially be borrowed will preserve the very attractive funding conditions for banks. This will help to ensure that they can continue to offer favorable lending conditions and have ample liquidity to extend loans to households and firms. Fourth, we decided to extend to June 2022 the duration of the set of collateral easing measures adopted by the Governing Council on the 7th and the 22nd of April 2020. The extension of these measures will continue to ensure that banks can make full use of the Eurosystem's liquidity operations, most notably the recalibrated TLTROs. The Governing Council will reassess the collateral easing measures before June 2022, ensuring that Eurosystem counterparties' participation in TLTRO III operations is not adversely affected. Fifth, the Governing Council also decided to offer 4 additional pandemic emergency longer-term refinancing operations, the PLTROs, in 2021, which will continue to provide an effective liquidity backstop. Sixth, net purchases under our asset purchase programme will continue at a monthly pace of 20 billion euros. We continue to expect monthly net asset purchases under the APP to run for as long as necessary to reinforce the accommodative impact of our policy rates and to end shortly before we start raising the key ECB interest rates. We also intend to continue reinvesting in full the principal payments from maturing securities purchased under the APP for an extended period of time past the date when we start raising the key ECB interest rates. And in any case, for as long as necessary to maintain favorable liquidity conditions and an ample degree of monetary accommodation. Seventh, the Eurosystem repo facility for central banks, Europe, and all temporary swap and repo lines with non-euro area central banks will be extended until March 2022. Finally, we decided to continue conducting our regular lending operations as fixed-rate tender procedures with full allotment at the prevailing conditions for as long as necessary. Separate press releases with further details of the measures taken by the Governing Council will be published this afternoon at 3:30. The monetary policy measures taken today will contribute to preserving favorable financing conditions over the pandemic period. thereby supporting the flow of credit to all sectors of the economy, underpinning economic activity, and safeguarding medium-term price stability. At the same time, uncertainty remains high, including with regard to the dynamics of the pandemic and the timing of vaccine rollouts. We will also continue to monitor developments in the exchange rate with regard to their possible implications for the medium-term inflation outlook. We therefore continue to stand ready to adjust all of our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner in line with our commitment to symmetry. Let me now explain our assessment in greater detail, starting with the economic analysis. Following a sharp contraction in the first half of 2020, Euro area real GDP rebounded strongly and rose by 12.5% quarter-on-quarter in the third quarter, although remaining well below pre-pandemic levels. The second wave of the pandemic and the associated intensification of containment measures observed since mid-October are expected to result in a renewed significant decline in activity in the fourth quarter, although to a much lesser extent than observed in the second quarter of this year. Economic developments continue to be uneven across sectors, with activity in the services sector being more adversely affected by the new restrictions on social interaction and mobility than activity in the industrial sector. Although fiscal policy measures are supporting households and firms, consumers remain cautious in the light of the pandemic and its ramification for employment and earnings. Moreover, weaker balance sheets and uncertainty about the economic outlook are weighing on business investment. Looking ahead, the news of prospective rollouts of vaccines allows for greater confidence in the assumption of a gradual resolution of the health crisis. However, it will take time until widespread immunity is achieved, while further resurgences in infections with challenges to public health and economic prospects cannot be ruled out. Over the medium term, the recovery of the euro area economy should be supported by favorable financing conditions, an expansionary fiscal stance, and a recovery in demand as containment measures are lifted and uncertainty recedes. This assessment is broadly reflected in the baseline scenario of the December 2020 Eurosystem staff macroeconomic projections for the euro area. These projections foresee annual real GDP growth at minus 7.3% in 2020, plus 3.9% in 2021, plus 4.2% in 2022, and plus 2.1% in 2023. Compared with the September 2020 ECB staff macroeconomic projections, the outlook for economic activity has been revised down in the short term, but is seen to broadly recover to the level projected in the September baseline scenario over the medium term. Overall, the risks surrounding the euro area growth outlook remain tilted to the downside, but have become less pronounced. While the news about the prospects for vaccine rollouts in the near future is encouraging, downside risks remain related to the implication of the pandemic for economic and financial conditions. According to Eurostat's flash estimate, euro area annual inflation remained unchanged at minus 0.3% in November. On the basis of oil price dynamics, and taking into account the temporary reduction in the German VAT rate, headline inflation is likely to remain negative until early 2021. Thereafter, it is expected to increase owing to the end of the temporary VAT reduction in Germany and upward base effects in energy price inflation. At the same time, underlying price pressures are expected to remain subdued owing to weak demand, notably in the tourism and travel-related sectors, as well as low wage pressures and the appreciation of the euro exchange rate. Once the impact of the pandemic fades, a recovery in demand, supported by accommodative fiscal and monetary policies, will put upward pressure on inflation over the medium term. Market-based indicators and survey-based measures of longer-term inflation expectations remain at low levels. This assessment is broadly reflected in the baseline scenario of the December 2020 Eurosystem staff macroeconomic projection for the euro area, which foresees annual inflation at 0.2% in 2020, 1% in 2021, 1.1% in 2022, and 1.4% in 2023. Compared with the September 2020 ECB staff macroeconomic projections, the outlook for inflation has been revised down for 2020 and for 2022. Turning to the monetary analysis, the annual growth of broad money, M3, remained broadly unchanged at 10.5% in October 2020. Strong money growth has been supported by the ongoing asset purchases by the Eurosystem, which have become the largest source of money creation. In the context of a still heightened preference for liquidity in the money holding sector and a low opportunity cost of holding the most liquid forms of money, the narrow monetary aggregate M1 continues to be the main contributor to broad money growth. The growth of lending to the private sector has plateaued, while still recording higher growth rates than prior to COVID-19 pandemic. Following strong increases in the early months of the pandemic, the annual growth rate of loans to non-financial corporations fell to 6.8% in October, after 7.1% in September. This deceleration has occurred in the context of abating emergency liquidity needs, weak investment, and tighter credit conditions on loans to firms, as signaled by our bank lending survey for the euro area for the third quarter of 2020. The annual growth rate of loans to households stood at 3.1% in October, unchanged from September. Overall, our policy measures, together with the measures adopted by national governments and European institutions, remain essential to support bank lending conditions and access to financing, in particular for those most affected by the ramifications of the pandemic. To sum up, a cross-check of the outcome of the economic analysis with the signals coming from the monetary analysis confirm that an ample degree of monetary accommodation is necessary to support economic activity and the robust convergence of inflation to levels that are below but close to 2% over the medium term. Regarding fiscal policies, an ambitious and coordinated fiscal stance remains critical in view of the sharp contraction in the euro area economy. Fiscal measures taken in response to the pandemic emergency should, as much as possible, be targeted and temporary in nature. At the same time, weak demand from firms and households, and the heightened risk of a delayed recovery in the light of the new lockdowns owing to the second wave of the pandemic warrant continued support from national fiscal policies. The three safety nets endorsed by the European Council for workers, businesses and sovereigns provide important funding in this context. The Governing Council recognises the key role of the Next Generation EU package and stresses the importance of it becoming operational without delay. It calls on Member States to deploy the funds for productive public spending accompanied by productivity-enhancing structural policies. This would allow the Next Generation EU programme to contribute to a faster, stronger and more uniform recovery and would increase economic resilience and the growth potential of Member States' economies, thereby supporting the effectiveness of monetary policy in the euro area. Such structural policies are particularly important in addressing long-standing structural and institutional weaknesses and in accelerating the green and digital transitions. We now stand ready for your questions. Thank you.
The first question today comes from Balázs Korányi at Reuters.
I'd like to ask, how did you arrive at 500 billion in 9 months? If you could give me a bit of a rundown, what were the alternatives on the table? What was the discussion? And in the end, was it a unanimous decision? Second question again is about the appreciation of the euro. It's an issue that's come back over the last few months. Was there a discussion about the exchange rate? What was the nature of the discussion? If you could give me a bit of color on what was said, what were the concerns expressed on the FX rate? Thanks.
Well, thank you very much for your question. And let me just sum up what we have decided, and then I'll go into the actual description of the package and the reasons behind it. What we have decided, as was anticipated as a result of the last October monetary policy discussions that we had, is a recalibration of those instruments that we determined were most effective under the current pandemic circumstances. And it is with that in mind that we decided to concentrate the recalibration on PEP, our temporary, targeted and flexible asset purchase programs that is specifically designed for the pandemic, on TLTRO version 3, which is intended to provide as much refinancing as possible to those banks that are lending to the economy and to offer a very attractive rate for those that actually comply with the objective and the threshold, which is to at least maintain, if not increase, lending to the economy. And then we, of course, decided also on all the measures that come with it, and in particular, the extension of the term during which collaterals are enlarged and taken into account for the purposes of TLTROs, and extension as well of our swap and repo line, and so on and so forth. So we decided, let's take first of all the duration. There was discussion as to how long should the extension be. But why should there be an extension first? Well, because clearly we are facing circumstances that are, in the short term, more difficult, and that difficulty has been caused by the second wave and the containment measures that have been taken as a result of such second wave. I think it's fair to say that we all had anticipated that there would be a possible second wave. It was actually embedded in previous projections, but the depth of it, the duration of it, and the containment measures associated with it were not anticipated to the extent that they actually occurred and are still taking place. So it was sensible to extend because of the impact that it has on the economy in short order. And I remind you that the fourth quarter is going to be negative, 2.2 we believe, and it's going to carry into the first quarter of 2021. And Why did we decide 9 months? Well, it's fairly simple. We are, unfortunately, economists, in addition to having all the economic knowledge and being able to anticipate, also have to be very aware and attentive to health literature and the forecast that scientists have in respect of immunity, in respect of vaccination, in respect of the rollout of vaccinations. And that's how we came up with this 9 months extension, because we have good reasons to believe, and you read the same material, we try to make sense of all of that. We have good reasons to believe that by the end of 2021, with uncertainty associated with it, let's face it, but we will have reached sufficient herd immunity to hope that by the end of 2021, the economy will begin to function under more normal circumstances, and that in particular the service sector will not be impaired by a lot of these social distancing and restrictions that apply to it at the moment and do not facilitate the growth of the sector. And then, so that takes you into the beginning of 2022, where the economy really begins to recover seriously, recovery takes root, and we are essentially 2 years after the beginning of COVID. So I think you combine all that and we arrive at this this extension by 9 months. Now, the volume of additional purchase that we have considered is clearly intended to deal with our focus, which is to preserve favorable financing conditions. And that is really what is guiding our action going forward. That will lead us to purchase in a slightly different way than we have in the past. As you will have noted in my reading of the introductory statement, we state very clearly, I think it's at the top of page 2 for those of you who have it, we say we will conduct our purchases under the PEP to preserve favorable financing conditions over this extended period. That is our objective. We will purchase flexibly according to market conditions and with a view to preventing a tightening of financing conditions that is inconsistent with countering the downward impact of the pandemic on the projected path of inflation. So it's all nicely embedded in that long and fairly complicated sentence, but that is what has driven our calibration of the additional PEP that we have decided. Now, you wanted to understand what our discussions had been about exchange control, about exchange rate. Let me just remind you our position. We do not target exchange rate, but clearly exchange rate, and in particular the appreciation of the euro, plays an important role and exercise downward pressure on prices. So we monitor it. We will continue to monitor it very carefully going forward. Thank you.
Okay, the next question comes from Annette Weisbach at CNBC.
Madame la Présidente, do you hear me?
Yes, very well.
Okay, very well. Thank you. So I have two questions. One, you must have read the Bank of International Settlement quarterly report as well, where they were saying that they are seeing a risk of a solvency crisis. So I would like to hear from you whether you think that's a risk in terms of the next phases of that crisis we are currently in. And then also another question on why didn't you touch the rate? Because clearly that would have dragged the rates lower into negative territory, but looking at the package, which kind of touched almost every instrument, why didn't you touch the rate?
On your first question, I think that the monetary policy that we have decided, as well as the fiscal measures that have been decided at member state level, as well as at the European regional levels, combined and, contrary to previous crises, working hand in hand, have managed to provide enough income and enough support by way of guarantees, by way of moratoria, in order to help the economy, from all sectors, to go across the pandemic and sort of cross that bridge with appropriate support in order to avoid the catastrophic fallout if there had not been those supports. And I think that in that respect, the monetary policy has played a significant role in supporting all sectors of the economy, in making sure that credit flows to the economy and that there is no major fallout in terms of solvency and insolvency. But this is a risk that is clearly looming on the horizon. And that is precisely the reason why we, for ourselves, encourage fiscal authorities to avoid the fiscal, the cliff effect that would result from a removal and the withdrawal of the fiscal measures. And that is also the reason why we have decided to recalibrate our two key instruments, the PEP and the TLTRO, in order to make sure that we continue to provide the necessary support to credit, to make sure that financing conditions remain favorable to all sectors of the economy, in order to go across the pandemic until such time when immunity has been sufficient in order to procure a situation where the economy actually picks up and is in recovery in a sustainable fashion. So I think that, one of the reasons we are acting in that respect now is precisely to avoid that potential risk and to take those companies, those corporates, those entrepreneurs, those households to the other side of the pandemic and to the other side of the economic consequences resulting from the pandemic. Now, on your issue of rate, I want to first of all point you to a clause that you know well, which is, I think, on page 1 of our introductory statement, which indicates very clearly, and that's part of our forward guidance, as you know, which says very clearly, when I read the first sentence, you understood clearly that we decided to keep the key ECB interest rates unchanged, and that is the case. And then I follow with, we expect them to remain at their present or lower levels until we have seen the inflation outlook robustly convert, So both routes are indicated clearly in this forward guidance. And of course, interest rates movement, particularly the DFR, is part of our toolbox. And as we have said for all our instruments, we stand ready to continue to recalibrate, adjust, and use all tools available in the toolbox.
Okay, the next question is from Isabella Buffacchi at Il Sole 24 Ore.
Thank you for the opportunity. President Lagarde, I have two questions. The first is again on negative interest rates. On the TLTRO, extended TLTRO, I suppose the -1% is going to stay. And if it is so, how important is this -1 for the banking sector? My second question is on your macroeconomic projections. The pandemic is a symmetric shock, but it has asymmetric impacts, as we know. And you use the word uneven for the sectors. I wonder if you can say more about these macroeconomic projections on how uneven the recovery will be amongst the member states of the euro area in 2021, and if you are worried about further fragmentation. Thank you, and if I may, best wishes to you and to the ECB for Christmas.
Well, thank you.
New Year.
Thank you so much for your good wishes. And let me say that we reciprocate to you and to all your colleagues, of course, because this is our last press conference before year end. So turning back to your question, you are right that we are keeping this very attractive minus 100 basis points as is, which is a very attractive rate. Now, let me just pause for a second on that rate, because we should not assume, and nobody should assume, that this is a rate that is available come what may and under no particular conditions and in all circumstances. It's a rate that is intended to incentivize the banking sector to provide financing to the economy. And it is not available without condition. It is only available if banks actually maintain or exceed the level of lending that they have provided beforehand. What are we doing with this TLTRO new measures? We're doing three things. We are enlarging the volume of lending that can be obtained at those rates. We are maintaining the rate where it is, minus 100 basis points. And we are also slightly changing the reference period, which is the base according to which the volume of lending is or not benefiting from the additional 100 basis points, to make it a little bit more challenging, because it is a very attractive program. And we think that it has proven very effective. When we look at various indicators, whether it is the take-up of TLTROs in June, massively above expectation. In September, still above expectations. Whether it is the volume of lending to the economy, either at corporate level or to households, we're also seeing a significant increase. Less so in October, for sure, for the reasons that are mentioned clearly in the introductory summary, but significantly still. And if you look at the rates at which those loans are procured to corporates or to households, it is virtually at the lowest levels ever. I think for households it has been once in May 2020, a little lower than that, but it is, I think it's 135% for households and a little over 1.5% for corporates. So on all three accounts, volume of take-up, increase of loans, rates at which lending is granted by banks, it's clearly working to the effect that we wanted. Now, the reasons we tried to continue to make it attractive and to enlarge it is because we're beginning to see some signals here and there, and particularly in the bank lending surveys, but in other surveys as well, that not so much about the rate, but about the terms and conditions that are offered to borrowers, we're beginning to see a little bit of a tightening. And we think that we should encourage, obviously, proper assessment of the risk. That is not to encourage unwarranted lending, or at least not properly assessed. But we think that lending conditions should be favorable. You asked me about the unevenness. I think what I referred to was the unevenness between sectors. When you look at past numbers, when you look at PMI, when you look at alternative flash estimates, it is clear that the industry is recovering, and the numbers in general are quite strong. Whereas on the other hand, the service sector is still bearing the brunt of the necessary social distancing constraint and other measures that put a brake on the service sector recovery. We look at numbers in aggregate basis in the main, and while it is clear that some countries started in this pandemic in a different positions from others, some having fiscal space, some not having it, some having a lower debt level and others having a higher debt level. We very much hope that Next Generation EU and the other tools that are made available, whether it is SURE, whether it is the ESM programs, or whether it is the guarantees that will supplement the national guarantees that would be offered by the EIB. We very much hope that these programs and the way in which they are provided will actually temper this potential uneven recovery on a jurisdiction-by-jurisdiction basis. And I remind you that we have designed PEP with that risk in mind, and we have applied in the rollout of PEP all the flexibility that was needed across classes of assets, across time by front-loading, and across jurisdictions in order to resist destabilization, restore stabilization, and make sure that the risk of fragmentation could be kept at bay. Thank you.
Okay, the next question is from Martin Arnold at the Financial Times.
Hello, Madame Lagarde. Can you hear me?
Hello, I can hear you very well, yes. Good afternoon.
Great. Good afternoon. I have two questions for you, both on the duration issue. The first question is, imagine the scenario that, as you said, risks are less pronounced, the vaccine is being rolled out, there could be quite a strong recovery in the economy and in inflation next year. Imagine that is stronger than you're forecasting. Would that lead to you curtailing your crisis management tools, the PEP and the TLTROs, earlier than expected during the course of next year? And secondly, how will the ECB decide when the pandemic crisis is over? On what metric will you look at? Is it on GDP? Is it on inflation? And when inflation is back on course, how will you judge that? Thank you very much.
Well, thank you so much for your question. I think we really tailored the extension of our PEP with in mind the potential duration of the pandemic-related crisis. Second, we did work on scenarios as well. I did not mention them in the introductory statement, but you will be seeing them when you see the projections when they're published later this afternoon. So we worked on scenarios as well to anticipate a mild scenario, a severe scenario, and sort of tailor our policies in respect of these two scenarios. But the special design of this extension is precisely intended to deal with that situation. And you will have noted that, as I had indicated back in October, and the Governing Council had decided, and as I picked it up in my ECB forum on central banking, which would have taken place at Sintra had it not been for the pandemic, we insist on maintaining favorable financing conditions. And that indeed is a factor of what is the economic circumstance? What are the economic circumstances? What impact it has on credit to the economy? What impact it has on yields across the board, from corporate to sovereigns? And what we plan on doing is to adjust our purchases on the basis of what is needed to maintain those favorable financing conditions. So, to take your example, if we have a strong recovery which has an impact on inflation that puts it back onto the path that we had pre-pandemic, then clearly financing conditions would be regarded as quite favorable and would not necessarily require that we do massive purchases. We would tailor our purchases on the basis of favorable financing conditions. Equally, if we had tightening of financing conditions, that would be inconsistent with countering the negative impact of pandemic on our inflation path, then of course we would do the right level of purchases in order to weigh on that. The compass, if you will, or the clear focus that we have will be those favorable financing conditions. And that will entail variable purchases. So it will be slightly different from what it had been in the past, not necessarily fixed monthly linear purchases, but purchases that will adjust depending on market conditions in order to procure those favorable financing conditions. When is the pandemic crisis over? Well, as I said, we have tried to learn and read from other scientists those that know better about viruses, vaccinations, and how long it takes to reach herd immunity. And based on what we know today, we have good reasons to believe that the end of 2021 will likely signal the herd immunity, and we've extended at least until March 2022 to cover the pickup of recovery and the resulting stabilization of prices that would operate as a result of that. As you have heard, we say at least until March 2022. And if it proves necessary, because the pandemic is not over, because the economic consequences are still bearing heavily on economic agents, then we will reconsider that timetable. And as always, and it's loud and clear in the introductory statements, we always stand ready to recalibrate, revisit all our instruments.
The next question comes from Georgia Solota at Naftaremki. Actually, I can't say, sorry.
Yes, Naftaremki. Good afternoon from Athens, from rainy Athens. I would also like to pose two questions. The first one is whether it would be possible for Greek bonds, with regard to their low investment grade, to continue to be accepted as collateral after the pandemic, if some requirements have met, and if so, which would these requirements be? And my second question is, when do you see a rise of inflation to healthy levels? I mean, it has to do with when will the pandemic end, but since the inflation rate has been low for a longer period of time, when do you actually expect it to reach close to the 2%? Yes?
Thank you. So on your first question about the Greek bonds remaining an exception, which they are at the moment, and at a later stage when PEP is over, this is not a matter that we have discussed at the Governing Council, obviously. In terms of inflation, let me say that first of all, it is disappointingly low. It has been negative for the last 3 months. It's at minus 0.3% yet again, and it is, rooted in some specific factors that have to do with the very low cost of energy. It has to do with the German VAT, and it is, in that respect, it is conjunctural. But it is also caused by weak demand. It is also caused by lower wages, and it is also caused by the exchange rate appreciation. So we have multiple factors that can explain the situation. Clearly, we expect those rates to improve in the course of 2021. You will remember that in our projection, we forecast 0.2% inflation, followed by 1%, followed by 1.1%, because of multiple factors. There will be base effects, there will be VAT, German VAT being reinstated to previous levels. There will be, hopefully, demand picking up and recovery taking hold, which obviously would exercise an upward pressure on price levels. But for the moment, the package that we have in place and the monetary policy that we are deploying corresponds to these exceptional circumstances and is therefore of an exceptional nature, which is the characteristics of PEP, for instance. So our determination, as is indicated in our monetary policy decisions, is to maintain favorable financing conditions in order to bolster confidence, in order to remove uncertainty, in order to make sure that recovery takes hold, and as a result, offset some of the negative impact created by the pandemic on our path of inflation. And that is with the hope that while at the end of this specific and exceptional program, we can hopefully return to the pre-COVID times, both in terms of output gap and in terms of inflation gap. That's really the intention. And of course, because our mandate is price stability, our ultimate aim is inflation at close to but below 2%.
Okay, the next question comes from Luke Hayton at M&I.
Good afternoon, President Lagarde. Can you hear me?
Yes, good afternoon to you.
Hi. Two questions, if I may. The first is, does today's decision, which sort of emphasizes financial conditions, mean de facto yield curve control? And secondly, what does the provision of more cheap central bank loans on condition of increased lending to the real economy do to address concern over the growth of non-performing loans across the euro area and in some countries in particular?
Sorry, I missed the second part of you. Can you repeat your second question?
Sorry, yes. What does the provision of more cheap central bank loans on condition of increased lending to the real economy do to address concern over the growth of non-performing loans across the euro area and in some countries in particular?
Okay, thank you. Well, first of all, thank you for your questions. On the first one, let me try to explain what we are doing with our monetary policy. There are three elements which characterize our policy. The first one, you've picked it up yourself, is preserving favorable financing conditions over the pandemic period. And this is crucial to build that bridge across the pandemic until we have reached herd immunity, so that the economy is well advanced, the economic recovery is well advanced, is self-sustained, and inflation is back to its pre-pandemic path. That's what we are trying to do. Second, to deliver on that commitment, as I have explained, our purchase envelope can be used flexibly. You've heard me many times talk about the flexibility across temporality, asset classes, jurisdictions. I'm talking about a slightly different flexibility here, because what we mean to do is to scale our purchases to whatever is needed to preserve the favorable financing conditions. And while the volumes that we have, what is left under the previous PEP, over 600 billions, plus what we have decided today, it allows us for a significant constant market presence. The envelope does not have to be spent in a predefined way, or even in full for that matter, so long as financing conditions remain favorable. Equally, the envelope can be increased if it is necessary, in line with our commitment to adjust all our instruments as appropriate to ensure that inflation moves towards our aim in a sustained manner. And third, we define favorable financing conditions in a very holistic way. So we're not looking at one single sector or one single indicator. We're looking at lending rates to corporates, lending rates to households. We're looking at corporate yields. We're looking at sovereign yields. We're looking at the supporting of credit flows to the economy. And we want to make sure that those financing conditions remain favorable for all sectors of the economy. So those will be our targets and our measurement instruments. On your second point, it is obviously for banks, who are the lenders ultimately, to assess and to manage risks and to take the appropriate provisions and to request the appropriate guarantees. Our job as central bank is to make sure that financing is available and can flow to banks that are doing their job of lending to the economy and financing economic agents. Thank you.
The next question comes from Guillaume Benoit at Les Echos.
You might be muted because we can't hear you.
Excuse me. Yeah. Can you hear me?
Now we can hear
No?
you. Yes, yes,
Yeah?
yes.
Okay, thank you. Sorry for that. Well, I had the answer to one of my questions. The other is that there are growing concerns about the fact that with the increase of the PPP envelope, the ECB may struggle to find bonds to buy due to the self-imposed limits of detention. Are you confident that if needed, you will find enough bond to buy to use the whole envelope, or is it a concern to you?
No, it is not. It is not because we have said over and over that any self-imposed limits that would impair the conduct of monetary policy would not stop us from conducting monetary policy. Added to which, I think that if you look at the level of issuance that is forecasted for 2021, 2022, both at national, at supranational levels, at agencies level from which we buy, there is quite a lot that is coming. But the key principle is that self-imposed limits will not be an obstacle to the proper delivery of our monetary policy.
Okay, and the next question is from Mark Berndeman at NSA Handelsblatt.
Hello, President Lagarde. Can you hear me?
Yes, thank you very much. Hello.
Thank you. Yes, I wanted to ask you two questions. You said there was discussion in the Governing Council about the length of the extension of the PEPP. So was today's decision unanimous? And my second question is about climate change. Your colleague, Governing Council member Jens Weidmann, said in a speech recently that there is no mandate for an active role of the ECB in the fight against climate change. He said an active role in climate change policy could undermine our independence and ultimately jeopardize our ability to maintain price stability. Would you agree with his view? Thank you.
I agree with many views of Jens Weidmann, the governor of the Bundesbank. On this issue of climate, I know it's very tempting to oppose my views and the views of my colleague and friend Jens Weidmann. There are lots of things that we agree upon, and I think that he's equally concerned as I am about the impact of climate change on our economies. I think that those issues will actually come to a head when we have the debate about climate change, which is an entire chapter of our strategy review. Because, and this is a view that I hold very firmly, while it is not here a question of substituting government, it is not a question of turning ourselves into a fiscal agent or into a regulatory authorities in the universe of climate change measures. And I think on that point I would completely agree with my colleague and friend Jens. Equally, I believe that in everything that we do, we have to be mindful of climate change impact in terms of risk and in terms of delivering on our mandate, which is price stability. And one of the debates that we will have as part of our strategy review is whether or not the direct and indirect impact of climate change have a bearing on our primary mandate of price stability. I happen to think that it does. Now, there might be different views, but I think we should debate those views, and we will do so as an institution. Equally, I believe that we have to look at our various portfolios, our own portfolios, our pension portfolio, as well as our monetary policy portfolio, to make sure that we assess risks properly. And in that respect, I'm very happy that the European Parliament has moved forward with taxonomy, that the Commission has now developed the soft law that is associated with that taxonomy, and will continue to develop even more work in order to make sure that we have the whole range from the very, very green to the not so green at the other end, so that we can have a proper understanding of our risk position, as will be important the obligation to disclose and explain that will hopefully be applying to banks in short order, which will require that they themselves conduct the due diligence in order to make sure that they properly assess the risk of their counterparty. So let me also mention that we are trying to make progress step by step, and in so doing, we have enlarged now our bond purchasable universe by now accepting, as of January 1st, green bonds that are associated with a variable coupon that are a factor of ESG criteria. This used not to be possible because coupon had to be fixed. We have now slightly varied that to accept and enlarge the green bond universe from which we can buy, and of which we are a significant purchaser for that matter. So on climate change, trust me, we're going to continue that discussion. And it's, as I said, it's not a question of substituting for other authorities who have to do the job. It's not for us to regulate. It's not for us to produce taxonomy. Others are doing this job and will continue to do it. But we have to bear in mind those risks and the direct and indirect impacts that it has on the natural interest rate, that it has on the price stability objectives, and the impact on inflation of, for instance, major weather circumstances, or drought, or carbon tax, if and when it comes, and so on and so forth. So we have great debates ahead, and they will come. Now, I guess we are out of time, so I can take at least 1 minute. Both of us, we take the time to wish everybody happy year-end, happy holidays, and we look forward to seeing you on the other side of the pandemic, of course, but on the other side of the year in 2021. Thank you so much.